Okay, so on Monday, we went through this process of debits and credits and talking about recording our activities in the journal and posting to the ledger. So we're going to just review that a little bit. The next few slides actually just repeat what we did on Monday, what I did on the board. But again, it's been a couple of days, and I want to make sure that we cover it one more time, and then we're going to take a look at some exercises. So remember the journal, right? Does everybody remember the journal? Just, again, reviewing some of the characteristics. The journal is the place where you write down what happened. So in this case, the owner gave money to the business. We called it an investment by the owner or the shareholder. Shareholder, owner, they mean the same thing. We've got a day column. Remember, we put the year at the top of the day column on the first page. Then we identify the month. We only write the month one time unless the month changes. We only write the year one time unless the year changes on that page. When we get to the second page, or the next page, we write the year again at the top. We write the month again, just so we always know when we're leafing through, we know where we're at. The next section, account titles and explanation. Here's where we identify the accounts that are affected by our event or our transaction. And in that case, it's always going to be at least two. We have had one example where there was three. Do you remember the exercise we did where the owner gave cash and equipment to the company in exchange for stock? Okay. And then we have that PR column. What's PR stand for? Who remembers? Post-reference. Yes, thank you. Post-reference. That's going to tell us where this information is going to be transferred or posted to. Because remember, this is just the place where we record what happens. We have another record where we keep track of the balances of all of these accounts after each transaction. And then we have a debit and a credit column. And what's the rule with debits and credits? They have to what? They have to equal, right? Debits have to equal credits. So when we look at what we learned in Chapter 1, which was identifying the accounts that are affected and then determining whether those accounts increase or decrease, we then add what we learned in Chapter 2, which was, okay, well, what does an increase to an asset translate to? It translates to a debit. What does an increase to common stock translate to? It translates to a credit. And so we have applied our rules. The fourth thing we did was then we took this information and we transferred it to that record or that document that looks like a checkbook register, right? We said we're going to have a whole bunch of little checkbook registers, one for every account that we have in our list, in our chart of accounts. And this is where we're going to find the balance of each of those accounts. And why do I need the balance? I'm doing all this recording. What's going to be the next step in my process after I record? What am I going to do next? What did you do in your homework? You did your transaction analysis in part 1, and then the second part was, come on, you remember. What did you prepare? You prepared financial statements, right? You prepared financial statements. I need balances for that. I can't prepare reports if I don't have balances of the accounts. This is where I'm going to get those balances from. So remember, the journal and the ledger, this is the ledger, now take the place of that column format that we did in Chapter 1, that transaction analysis. All right, so I need this information. Here, 5,700 is the balance of cash. I would need that to prepare my financial statements. The income statement, the statement of retained earnings, and then the balance sheet. All right, so some characteristics of the ledger. Each ledger is going to have an account title, right? Account number. This is obviously we're reporting transactions for year 2013, so that's been entered. And then that initial post, a debit to cash for $30,000 from that first journal entry, that's where that came from. And remember, PR stands for post reference, so in here, we're going to put the page number of the journal page. And we're going to see that here. So this was just an example of what one looks like filled in. We'll get to the details here. Now again, we went through this a little bit, but here we can see it again in the slides. We review a little bit. So cash. The word post means to what? Transfer. So I'm going to transfer that $30,000 to the cash account in the ledger. Okay? I'm also going to do that for common stock. I have to do it for every single account because every account will have a balance that will be used then to prepare financial statements a little bit later on. So we enter the date, we transfer or we post the 30,000 as a debit because that's what we did to it in the journal. If we debited it in the journal, we're going to debit it in the ledger. Okay, do the same thing. Since this is like a little checkbook register, and you'll notice there they use G1. Remember I told you you can use GJ, G, or J. I don't care, and the page number. Okay, I will know what any of those mean, so you can use any of them. All right. Because cash had no balance before, and we just added $30,000 to our cash, we now have a balance of $30,000. Okay? You guys remember this? Yes, Greg.
Do you write the month every time in the ledger?
No, you don't have to write the month every time either. Again, it's going to be an electronic record. So depending on the program too, when you pick the date, the month may come up. But like when you're doing it manually, you try to save time any way you can. You only write the date when the month changes. Or you flip to another page, and then at the top of the next page, if you're still in the month of December, for example, you'd have to write December again just to identify the month for that particular page. But you only have to write the month when it changes. If it's a computerized program, and again, you're selecting dates very quickly, it may show the month every single time. But for manual purposes, it's not going to. And so this tells me, as soon as you enter this number in this post-reference column, that tells me, or it should tell me, that you've transferred that number to the ledger. I don't want to see that 101 number up here unless you've actually done the transfer. Okay, that indicates to me that you transferred the number. So I don't want to see that number unless you actually transferred it. It's kind of a checkpoint for you. If you know that you transferred the number, insert the account number to which you transferred that number. That tells you you're done with that. Then you can move on to the next one, which would be common stock. So what this is an image of here is this is an image of, okay, what we did in chapter 1, and then our little shortcut we learned in chapter 2, the T account. Remember the T account? The T account takes the place of, those formal records, the formal journal, the formal ledger that we just looked at. When we want to do things kind of quickly, we just draw a bunch of T's. It's a lot easier, but they serve the same purpose. But you certainly wouldn't be using them in a formal setting in your office. You could use them as, kind of scratch paper to figure things out. But an official record, a T account's not an official record. It's just a shortcut for us, okay? So this is just an example of, hey, here's what we did in chapter 1. We had our columns, right? So we had a plus 30,000 to cash and a plus 30,000 to common stock. And then they get, in the T accounts, posted to the correct side of the T. For cash, it's the left side or the debit side. For common stock, it's the right side or the credit side. So it's just kind of a quick assessment there. There's what we replace it with now, that double entry accounting in the journal. So we journalize it instead of this, we do this and this, okay? Journal, ledger. T account's the shortcut for the ledger though. Remember how I tried to draw a picture of the ledger on the board the other day, and then I kind of highlighted where we get the T from. You guys remember that? Okay, good. And that's where the T account comes from. So actually what happens here in the next few slides is it goes through and it does each transaction that we actually had in a previous chapter. So remember supplies. We bought supplies with cash. Cash went down, supplies went up. Now we're using debits and credits, so you have to first know that both cash and supplies are assets. So if supplies is increasing, we debit supplies. Since cash is decreasing, we credit cash, excuse me. So our entry in the journal is a debit to supplies. Remember, we put the debit, we write the word, the account name as close to the margin as we can. We indent the credit, right? Because over here, the credit column is to the right of the debit column. The account numbers 126 and 101 indicate that those values have been transferred or posted, bless you, posted to the T accounts. And there they are. So you'll notice now, these transactions were not listed by date. They were listed 1, 2, 3, 4, 5, 6, 7, 8. Okay? And so we're still listing them as that. But when we post, we want to give some sort of reference so that we know what transaction that number came from. So you'll notice over here now, cash has a debit of 30,000 and a credit of 2,500. If we wanted to know the balance, I would just have to subtract the two. So the T account does serve the same purpose as the ledger in providing me a balance if I need it quickly. It's just a lot quicker, a lot easier to draw the T account at this point. And we had equipment. So fast forward purchases equipment, paying 26,000 cash. So here we had another Example where we exchange one asset for another asset. And so cash goes down, equipment goes up. You have to know that both of those are assets. Then you have to look at your debit and credit rules, right? So if equipment is increasing, we increase an asset with a debit. If cash is decreasing, we decrease cash with a credit. And if you're not comfortable with knowing those rules just yet, have them in front of you. It's fine. You're doing homework. That's how you learn them. Have them in front of you on a separate piece of paper, on a note card, whatever works for you. In the journal, we list equipment first because we always list the debit first. So if we have 2 or 3 debits, we list those before we list the credit. Okay? Then we indent our credit. These numbers indicate that I've posted to, in this case, the equipment account and the cash account. So equipment was debited in the journal, it gets debited in the ledger. Cash was credited in the journal, it gets credited also in the ledger. Okay? Everybody okay? Questions so far? All right, so here we bought supplies, but this time we didn't pay for them. Remember that one? We purchased them on credit, which meant that we have a vendor or a supplier who's willing to give us or extend to us 30 days to pay. And so if we're not paying right now, we've created or incurred a debt, a liability that we're going to have to pay later on. So we did get something though, right? We got supplies. So supplies is an asset. If we got supplies, it's going to increase. We increase that with a debit. But accounts payable also increased, right? But because it's a liability, the rules tell us that liabilities increase with a what? A credit, right? Liabilities increase with a credit. So when we journalize that, again, think of those debit and credit rules, right? Assets increase with a debit, liabilities increase with a credit. And after each transaction, I have to have at least one debit and one credit because they have to equal. That's what the rules tell me. So they have to equal. And I always tell students, if you are 100% confident of at least half of the transaction, then you can assume the other half, right? I mean, even if it doesn't make a lot of sense to you, because I said sometimes these won't make sense to you. You're going to want to do something other than what the rules tell you to do, and it's based on your personal experience with banking and things like that. But you got to go with the rule. So if you're certain of at least half of the transaction, then the other half has to be the opposite, right? It has to be, if you know for a fact that supplies gets debited, you know that the other side has to be a credit to something because you have to have at least one debit and one credit, okay? So use that to your advantage, even if you're not 100% certain. Even if crediting accounts payable doesn't necessarily make sense to you. And remember, think of accounts payable like your credit card. If you use your credit card, what happens to the balance? It goes up, right? Right. Okay, so accounts payable is going to increase if you take advantage of the credit that a customer has extended to you. All right, so we've got Fast Forward provides consulting services and immediately collects $4,200 in cash. Remember we called revenue, what the definition of revenue was? Revenue is earnings. Exactly, revenue is earnings. So if you provide your service, you earn the revenue, even if you didn't get the cash, but in this case, we got cash. So cash went up and revenue goes up. So if you look at your debit and credit rules, you know that we increase an asset with a debit. That one you probably remember now. You probably don't need to study that one anymore, right? And revenues, if you look at your rules, revenues increase with a credit. And it has to be a credit, right? Because you already know the debit. So the other half has to be a credit to something, okay? But if you look at your rules, you're following the rules. So now we're kind of getting multiple entries in that T account, that cash T account. So, we've got some debits and some credits now, and hopefully you remember how we balance that, but we'll come back to that here a little bit later on. But again, the purpose of all this, record and report. This is just the recording phase. I'm recording so that eventually I can prepare reports. Why do I prepare reports? I prepare reports for external users, people outside the company that need to know how my business is performing. The bank, for example, if I want to borrow money from the bank, I have to be able to provide them financial information. That's what we're generating here. We're generating that financial information to share. All right, so I'm going to stop there, and we're going to do a little bit of practicing. Does anyone have any questions? I don't want to talk about the trial balance till Friday. Anyone have any questions? All right. We're going to do a couple of different things here. So I'm going to start off with just taking a look at some of the quick study problems, which are not in Connect. So I do not put those in Connect. We're going to look at them up here together, and maybe. So if you have a book, page 83, if you don't want to open your book, it's fine. Obviously, you can see it up here as well. But I'm going to go through just a couple of these. And I'm going to just pick a few random ones here. Let's take a look at quick study 4, right in the middle there. QS 2-4, this one. Okay. Remember we talked about the normal balance. Who remembers what I said the normal balance meant, or what was it? The normal balance of any account is what? Is the plus side, right, is the plus side. Now, a plus can be a debit or a plus can be a credit. It depends on the account, right? And it's important to know the normal balance because after we do our journalizing and our posting, we actually stop and kind of double check our work. Because if we have any mistakes, I'm hoping you're starting to see what I call the domino effect here, right? Which means if we make a mistake in the journal and we transfer that mistake to the ledger, what happens now? We've got a mistake in 2 places, right? And then if we go on and we prepare our financial statements with an incorrect ledger balance, what's the matter with our financial statements? They're wrong too. So, domino effect. If you make a mistake early on, everything after that's going to be incorrect. So what we do after we journalize and we post to the ledger is we actually stop and we kind of check our work. And that's where that trial balance comes into play, which we haven't learned yet, but that's where that comes into play. But the normal balance, knowing the normal balance, is going to help you to determine if you've made any mistakes or not. It's just one of the tools that we use to figure out if we screwed up anywhere before we continue to move on, okay? So an exercise or quick study 2-4, it says identify the normal balance. You're going to tell me debit or credit. That means you have to know the rules, right? So A is office supplies. What would be the normal balance of office supplies, a debit or a credit? A debit. And really what you're telling me is the normal balance of any account is the side that it increases on, right? It's plus side. B, dividends. What is it? Debit. Yeah, debit. Look at your rules. If you don't have your rules in front of you, get them out. I'm not going to stand up here and give you all these answers. You're going to tell me. Get your rules out. You got to practice. You got to know what they are. You just wrote them down. Yes, and maybe you memorized them 2 minutes before I handed out the test and you hurried up and you wrote them down, which is fine. But you still have to practice them, okay? Fees earned. Credit. Because fees earned is a revenue account. Yeah, maybe we haven't seen that term. So here's another opportunity to start, adding to our list. We've been seeing revenue accounts that actually have the word revenue in them. Consulting revenue, right? But fees earned is also a revenue account. It represents the fee you charge your customer for the service that you provide. That's earnings or revenue, okay?
Revenue increases with credit?
Yes, revenue increases with a credit. So fees earned, credit. Fee, wages expense, normal balance, debit. Look at your rules. Expenses increase with what? The debit, right? So the normal balance is a debit. Accounts receivable. First of all, what is accounts receivable? What classification? It's an asset. And assets have a normal balance of a debit. Correct. We didn't talk about F at all. All right? I said we would, but we haven't yet. Prepaid rent. Debit. Prepaid rent is actually an asset. Anything prepaid, and let me explain it to you. Oh, I hate to write on the board. It's so nice and clean. Prepaid is an asset. So anytime you see the word prepaid, I don't care what comes after it. The word prepaid tells you it's an asset. If you pay for something in advance of being provided a service, for example, it's an asset to you. Insurance is a common example, and so is rent. Okay? So we've got prepaid rent in this example. Anything prepaid is an asset, and assets have a normal balance of a debit. Okay? G. Wages payable. Anytime you see the word payable, what do you think? Liability. And liabilities have a normal balance of a credit, because they increase with a credit, that's right. Transaction H, or letter H, building. Building is what classification? Asset. So you got to ask yourself that first. That's why I gave you that little exercise before your quiz. You got to start to get into the habit of being able to identify, is my account an asset, a liability, an equity, a revenue, or an expense? You have to know that in order to be able to apply the rule. So buildings are assets, therefore they have a normal balance of a debit. Common stock, normal balance, credit. Okay. All right, so now let's jump down. We're going to skip 5. Let's jump down to number 6 here. You got to think. You have to have your rules out. If you got your rules out, you'll see your pluses and your minuses. Okay? It says identify whether a debit or credit yields the indicated change. So in other words, what causes land to increase, a debit or a credit? That's what we're looking for here. So again, our answers are debit or credit. You got to know your rules, and you got to know your classifications. So letter A, to increase land. We first need to know that land is what? An asset. And we increase assets with a debit. Right. So you kind of have to go through those steps. It's when you start skipping steps, because you feel a little confident, that you start making mistakes. B, to decrease cash. Well, we know cash is an asset, and we decrease assets with a credit. Right. To increase office expense. Well, expenses, we like expenses because they all say expense. Okay? So expenses have their own classification, right? I mean, it is an equity account, but we separate revenues and expenses from equity specifically because we do have so many of them. So how do we increase an expense account? With a debit, right? Now look at your rules. To increase, letter D, to increase fees earned. Fees earned is what classification of the 5? Which one? Revenue. And how do we increase revenue? Credit. So D is credit. There's another one that we are going to see in this chapter. The ones that I haven't kind of talked too much about yet are best explained with an example. So that's why I'm kind of waiting to get into a problem that has an example because it makes a lot more sense to understand them. So the next one, which is E, to decrease unearned revenue. Anything unearned is a liability. Okay, so to see the word unearned, it's a liability. So how do we decrease a liability? We debit it, correct. Yep. So again, you gotta know your rules. So anything prepaid is an asset, anything unearned is a liability. Transaction F, to decrease prepaid rent. Well, I kind of helped you out. I told you anything prepaid is a what? An asset. So how do we decrease an asset? With a credit, right. Letter G, to increase notes payable. Anytime you see the word payable, liability. How do we increase a liability? With a credit. Letter H, to decrease accounts receivable. Accounts receivable is what classification? Asset, right? Everybody agree? Accounts receivable is an asset. How do we decrease an asset? With a credit, right? Transaction I, to increase common stock. The normal balance of common stock, increase side is a credit, right? Letter J, to increase store equipment. What is store equipment? Store equipment is an asset. Assets increase with a debit. All right, with me so far? Hopefully. All right, so I'm going to jump over here to exercise 2.4. And this one I'm going to also do manually. This one actually is in Connect. We'll get to Connect here in a minute, but we're just going to, since this is just as easy to do up here. Exercise 2.4, and this one is on page 85. And then I'm going to have you guys get your, open up Connect here. So let's take a look at this one. It says, for each of the following, we got a couple of different things we have to do. Number one, identify the account type as asset, liability, equity, revenue, or expense. Okay? Number 2, identify the normal balance of the account. All right, which means tell me if the normal balance is a debit or a credit. Number 3, enter debit or credit to identify the kind of entry that would increase the account balance. Well, you'll see how this is going to work out here when we get started. But anyway, all right, so let's start with cash, right? So cash, what is it? It's an asset, right? Normal balance? Debit. How would we increase the account? These two are going to always be the same, aren't they? Yeah. It's kind of a silly thing, really. They're going to be the same because the normal balance of any account is the side where the plus is. The plus means increase, right? So those two answers are going to be the same. All right. Legal expense, B. Keyword there is expense. So it obviously is an expense, right? So I'm not going to write all these out, but just so you get the idea here. So legal expense is an expense. Normal balance is a debit. Therefore, the increased side is also a debit. Right. Okay. You with me on that? Good. All right. Prepaid insurance. Anything prepaid is an asset. Correct. Assets have a normal balance of a debit, and they also increase with the debit. Yes. Letter D, land. Asset, normal balance, debit, also increases with a debit. E, accounts receivable. What kind? Classification. Asset, normal balance, debit, therefore it also increases with the debit, yes. Letter F, dividends. Equity, yeah, remember equity is common stock or dividends, right? So that's classification is equity. But you have to be careful here because equity in general has a minus and a plus, right? Increase with the debit, decrease with the debit, increase with the credit. The dividends are a component of equity. And dividends actually decrease equity, so they're going to have the opposite effect on that balance of equity. So dividends are an equity account, but they have a normal balance of a what? A debit, and therefore they increase with a debit, right? That's why you gotta have your rules in front of you, okay? Some of the rules are, there's always exceptions to every rule, right? Here we have another revenue account. We've got lots of different names we can call these things, so you can kind of learn what, how to identify them. License fee revenue. Well, the word revenue's in there, so it's a revenue account. Revenues have a normal balance of a credit, therefore they also increase with a credit, right? Unearned revenue, letter H. Yep, anything unearned is a liability. Liabilities have a normal balance of what? A credit, therefore they also increase with a credit. Letter I, fees earned, revenue. Revenues have a normal balance of a credit. Look at your rules. Revenues have a normal balance of a credit, therefore they also increase with a credit. Letter J, equipment. Asset, normal balance, debit, increase with the debit. Notes payable, key word there. Yeah, payable, right? It's a liability, yes. And liabilities increase, or normal balance is a credit, therefore they increase with a credit. And then common stock. Normal balance is a credit. Increase with a credit. What's the classification? Equity. Very good. Okay. Yeah, so, we start to add to our list. It keeps growing, and we've got to make sure we know the classifications of these accounts. So I'm going to switch over here to Connect for the last few minutes that we have together here. And I'm going to click on Chapter 2, Homework Practice. If you want to follow along, you're welcome to do that. If you just want to watch, you're fine. Do that as well. In any event, pay attention either way. So we're going to take a look at, let's see if it's the same number here.
Where is it?
It is in week
3?
I think it's week 3. It's week 3. Homework practice link there, the last link on the page. Under content, week 3, homework practice, okay? So it is going to be question 7. You can kind of get an idea here, we'll look at this together, how the journal entry part works in Connect. So, back in the day, we used to have to do this manually on a manual sheet of journal paper. Now we have the computer, which makes things pretty nice. So what we see here is we see a list of activities that took place, business activities or transactions that took place for Madison Harris's company called Pose for Pics, all right? We're looking at a time period of August 1st through August 31st, and we have a variety of transactions. So we're going to apply sort of our steps that we talked about the other day, where we're going to identify the accounts that are affected. We're going to determine whether those accounts should be increased or decreased. And then we're going to look at our debit and credit rules and translate those increases and decreases into debits and credits. You with me? All right. So if you scroll down a little bit, and this is the thing, sometimes depending on the computer or the screen you're looking at, you kind of lose this up here, but you can always kind of view the list a little bit. They always have links later on that can give you a pop-up window. So we have the first one here, and you'll notice there are 5 of them. You see right here, 1, 2, 3, 4, 5, okay? And this is all highlighted. So the idea is to do one entry at a time. And the first one is listed. It says Madison Harris, the owner, invested $6,500 cash and $33,500 of photography equipment in the company in exchange for common stock. I'm hoping by now that this transaction, you're sick of it because we've had it so many times, right? You know this one in your sleep, I'm assuming. So what accounts are affected by this particular transaction? Now in this case, there's more than 2, right? But there's at least 2. But what are they? Cash, photography equipment, common stock. So those are the 3 accounts, right? Well, what do we want cash to do? Increase or decrease? Increase. And how do we increase cash? With the debit. So I'm going to go to my journal, my very first line, and I'm going to select cash. And I'm going to come over here to the debit column, because remember, I want to list my debits first. And so I'm going to enter 6,500, okay? And it tells you right down here, look, it says, enter debits before credits, right? Okay. What else should be increasing? What else did she give to the company? Photography equipment. So you've got your drop-down list now. If you start typing in photography, the word photography, it'll pop up. So we've got photography equipment in the amounts of $33,500. Okay. So I'm done with my debits, right? I mean, the only other thing I have is common stock. And we all know that common stock in this transaction needs to increase. So how do we do that? We have to credit common stock, right? So 3rd line, remember 1 line per item. Now you'll notice common stock isn't indented just yet. But watch what happens when I tab over to the credit column and I make my entry. How much am I crediting common stock for? $40,000, right? Because 6,500 plus 33,500 is 40, isn't it? Yes. Notice what happens when I enter that 40,000 and I tab. You see how it indented common stock for me? Okay. So this is a lot nicer than writing all this out, isn't it? Okay. Now, I can record the entry and move on to the next one if I want. If I made a mistake, then I can clear it and start over. If I'm done with the whole problem, I can hit done. If I want to double check my work, don't forget that nice little feature, check my work, will give me the pop-up window, and it'll just tell me if this is correct. So remember, you've got to have the correct label or the correct account, and also the correct value. Okay, now it says answer is not complete because I only did 1 journal entry. That's why it says not complete. Okay? Questions, problems, anyone having? Anything? All right. I can record the entry, and then it moves me to number 2. All right? And up here, I can also page between entries by hitting each of these arrows here, too. All right, the next one. The company paid $2,100 cash for an insurance policy covering the next 24 months. Perfect time for me to explain to you why prepaid insurance is an asset. When you buy an insurance policy, you buy it for a period of time that has not yet happened, correct? Are you aware of that? So, I can't be in a car accident last week and call my insurance company up and say, oh, I need insurance for, I need auto insurance, and then tell them I was in an accident last week and expect that auto insurance to cover it. That's not how it works. You're always paying for insurance for a period of time that is yet to happen, no matter what it is. Homeowners, auto insurance, anything like that. You're prepaying. So if I decide that I'm in the market for auto insurance and I go and I purchase a policy today, and I buy a 1-year policy today that does not become effective until October 1st, I have the rest of this month of September to cancel that policy and get all of my money back if I want to. Why? Because I haven't used any of it yet, right? Because October 1st hasn't happened. So essentially, when I purchase that policy, I own it, don't I? It's my insurance policy, so it's an asset. Remember, an asset's anything that we own, right? So I own it. All right, so it's an asset. We'll talk about what happens a little later as that insurance expires. So if I decide to keep that policy and October 1st comes and goes, at the end of October, how much of that insurance policy has expired? My effective date was October 1st, and it's now October 31st, 1 month, right? Or 30 days worth of insurance is now expired. Can I get that money back? No, I cannot. So we have to deal with that a little bit later on. But initially, when I buy the insurance policy, I own it. It's mine. Because I own it, it's an asset. So what did we call that account that represented the insurance policy that was an asset? And here's the thing. If you're not sure, you've got a drop-down list. Remember, you got like a word bank here to pick from. So it says the company paid cash $2,100 for an insurance policy. That insurance policy is going to be called prepaid insurance. And anything prepaid is a what? It's an asset. And how do we increase an asset? With a debit. Now here's a great example, folks. If you aren't sure what to do with prepaid insurance, I'm certain that you know, out of the way there, I'm certain that you know it says the company paid $2,100 cash. I'm certain that you know what happens to cash in this example, right? What happens to cash? Is it going to go up or down? It decreases. And how do we decrease cash? With a credit. So I'm 100% sure that you are sure that cash would be credited in this example. So if you're not really sure what to do with prepaid insurance, you have no choice but to do what with it? Debit it, because cash is already your credit, right? You already know that cash is being credited, and you have to have at least what? 1 debit and 1 credit, because they have to what? Equal. Yes. Debits have to equal credits. Keep that in mind. So if you know one side of the equation, the other side you can almost always figure out. Your debits have to equal your credits. All right, so I hit record. Now we're on the third one here. So the company purchased office supplies for $880 cash. You tell me what I'm doing here. What's happening? So office supplies, right? What are we doing with office supplies? We're buying them. So we're going to do what? Debit or credit? We're going to debit office supplies. Yep. Because office supplies should increase, right? And what are we using to pay for those? Or how are we getting those office supplies? And cash is going to do what? Decrease, so we want to credit it. Exactly. Kind of getting the hang of this? Questions on that one? All right, let's record that. Moving on to the fourth transaction. We got like 3 minutes. Let's get these 2 transactions done. The company received $3,331 cash in photography fees earned. Okay, so what are the 2 accounts do you think are affected here? Cash and photography fees earned. What are you getting? You're getting cash. So cash has to do what? Increase. And how do we increase cash? With the debit. So what has to happen to photography fees earned? Oops. Yeah, you have to credit that, right? But it is a what? What kind of account is photography fees earned? It is a revenue account. And revenues increase with a credit. Questions? One more. The company paid $675 cash for August utilities. Okay, so what two accounts do you think are affected here? Cash and utilities expense. Now, think about this though. Anytime we record utilities, we want to keep a running total of the total utilities we've incurred. So what do we want our utilities expense account to do? Increase or decrease? Increase. We're keeping a running total, all right? Eventually we'll subtract the total off, but right now we're keeping a running total. So how do we increase an expense account? With the debit. So utilities expense, okay? We're going to debit for $675. What are we using? We're using cash. And cash is going to go down, so we want to do what with cash? You want to credit cash. All right? So I can check my work again. And look, there are all my entries all together nicely. It says the answer is complete and correct. Okay? So bring your laptops with you on Friday. We're going to do a little bit more practice with this. We're going to practice posting to the ledger. We're going to talk about what the trial balance is and kind of wrap up this chapter. Then I'll know more about when your test is going to be exactly. You do have a Learn Smart that's due Friday. Yes, thank you for reminding us.